Now, before we kick off the second segment, we'd like to remind you, please like, share, subscribe. Your support is very much appreciated. We have our new show, the Pregame Show, where we talked a little bit about some of the things that we're going to look at, and then obviously we're going to go deeper into some of these topics with some of the data points that we try to pull. And I think this is an important one as we sit on the inauguration of President Biden, and what does that mean going forward? And here are some of the outlines of some of the plans for stimulus. And nothing is really surprising based on what we've already seen proposed, where direct payments of $1,400 to Americans, which is going to bring that total to $2,000. Again, that's the 600 payments that we've already seen. That'll be an additional $1,200. An increase in federal per week unemployment, which is kind of that expectation of kicking that pandemic support going forward as we continue to see an increase, or the amount of people sitting on unemployment for over 26 weeks, 29 weeks, and they're going to need this extended support as they are struggling to find jobs just because there aren't as many jobs available. Increasing the federal minimum wage to $15. There's pros and cons to this, and we've covered it in other sectors. Just to kind of give the pro, obviously you're going to give people more money. This will help push through some inflation as we'll get some wage increases. But then on the counter side, you're going to look at, well, if the company or the store or whatnot can't increase their prices because of all of the other issues we've talked about, where they're facing other input price increases, well, does that mean if you have 4 people working for you, you're not going to have 3.5 because you're going to raise in prices some, and then you're going to cut some hours, or you're going to just lay someone off completely? Like, these are some of the things that are going to be problematic when we look at enforcing this over the longer term. Extending eviction and foreclosures, that's something that has been talked about through September. Again, this is going to be a much bigger issue because the individuals, if you don't have to pay, will you pay? And we saw this with some of the bank earnings, bad debt expense. How much should you set aside? Because some of the latency in these payments, is that going to increase? Is that going to, someone who may have levered up to buy another property is now facing additional shortfalls? These are going to be some of those questions that we really won't know until we get further into the year and get some of those data points. Some of the others are pretty standard and things that I think everybody can agree on. $350 billion in state and local aid, $170 billion for schools. I mean, anyone who has kids in school know the pain that has happened, the amount of stress on not only the parents, but the administration, the students themselves. So that's not something that is insane to consider when you look at the struggles. $50 billion toward COVID testing. Obviously, testing is important. $20 billion to vaccine programs. Again, we've seen the issues with vaccines. Some Moderna cases had to be thrown out because they arrived too cold. We've seen Pfizer cut their deliveries into Europe just because they're trying to rejigger one of their assembly lines to increase them. Again, the logistical problems of getting this stuff through the system is going to be a bigger issue. So again, money is... It goes away, but again, it goes further to helping that issue. But again, these are issues that are going to be a much bigger problem than making the child tax credit fully refundable to $3,000 to $3,600. Again, these are things that are just trying to help those with kids that may have lost some work and or have seen their prices go up. These are some ways to try to offset that. And it's mostly bipartisan. So it's not really anything that we're going to see, because anyone who says on the Republican side, somewhat support on the independent side, again, we're going to see this push through. The question is going to be how much. And during Yellen's, when she was going through her vetting before the Senate, she was essentially saying, look, I'm going to try to put together a second stimulus package, who doesn't know that that's coming? The question is going to be, how is it going to be financed? Where is it going to go? How are they going to direct it? And that's going to be something bigger. And the 2 points that I think we're going to highlight in this specific section is not only the second component of stimulus that's going to come from the fiscal side, but also her commentary saying that they're going to remain tough on China. They're going to continue to put pressure on them on the currency side, on the fiscal side, monetary side as well. We continue to get comforted that the Biden administration is not going to pivot really too much away from some of the pressures that we've seen the previous administration, the Trump's administration, and Obama's second administration, and the pain or the pressure that they've continued to put on not only the Chinese government, but then the Chinese economy. But when we look at the U.S. Treasury federal deficit, obviously the deficit continues to rise. Obviously, we're issuing more debt in order to finance all of these different initiatives, and it's being absorbed not only into the public markets, but also going from the public markets being turned around and sold to the Treasury, to the Fed. And again, these are things that we have to look at as how sustainable is this, and for how long is it sustainable? And Yellen has said that, look, we can't worry about how sustainable it is, because we have to have something to worry about on the other side, which is fair in the sense of you can never do too much. But at the same time, then she said, but we have to be on a sustainable path. Well, just going back in time, how sustainable is this path? And where does that put the dollar? And where does that put FX reserves and currencies in general as we continue to see this pain arise? Now, I think there's going to be, again, this is looking at the US dollar, and asset managers are short USD via futures, including versus British pound. And right now, this is the biggest short position we've ever seen in the dollar. And while I get the reasoning for that, as you know, the advent of more printing, you're going to see more dollars going into the market, there is a natural buyer to dollars, which is emerging markets, which is euro dollar futures, which is just euro dollar trade in general, as we've highlighted that over 80% of accounts receivables are priced in dollars at emerging markets. So again, there's a natural buyer. So even though we're adding some of these additional dollars, there's that natural bid that continues to come in. And on the other side of it, it's now going to be less about the US dollar and more about what is it paired against. Because we've seen additional problems in Europe, as we talked about in the first segment. We'll go through more detail in the fourth segment. As those issues rise, the Italian government, you know, they skated through on the most recent confidence vote, but the euro starting to show some cracks. You know, is Lagarde going to try to do more to stimulate the economy as these lockdowns expand from the ECB's perspective? You know, these are things that are going to continue to weigh on the euro. And I think it's really a euro CNY and or, you know, renminbi and the yuan question, because China's looking to tighten up a little bit. If they're tightening up a little bit, well, what does that mean? Or can they tighten? Are they going to try to print again and push more stimulus into their own market, which is probably likely at this point, because right now people are long euro, short dollar, long GBP, short dollar, long oil, short dollar. So you have a very crowded trade, and people have the same short side, but different long sides. So the question is, if you start to see some of this concern or people taking off some of these trades, you know, are you going to get that snapback in the dollar, which is where we continue to see, as the levered funds, asset managers, all of these USD positions continue to get further and further negative, while we're expecting a steeper yield curve. So as the yield curve goes up, that means that you're going to see more people essentially incentivized to purchase our debt. And again, as we talked about with Powell not talking about raising rates, well, the market's going to raise rates for him. And now, given we've had expectations before, the expectations have been lofty, but this time, you know, the question is this time different? And the short answer is yes. And it's purely because we're at a very different point in time, not only on the stimulus cycle, as we really haven't seen much. Obviously, the taper tantrum was a big thing. You know, the election was another one in 16, and now as we sit here in January 2021 with another election, another concern as we look at stimulus, this is going to be something to watch as, again, that inflation fear starts to get priced in. Now, when this is courtesy of Matthew Water looking at U.S. budget deficit versus Fed balance sheet. You can see the deficit has increased as we look at the blue line, but you've seen the Fed balance sheet. So when you think about right now, you know, a tit for tat, where every time you see the Fed budget deficit increase, the Fed balance sheet is increasing. And at what point does that stop? Can that stop? Or is this MMT working? Are we seeing this just one-for-one transition? But when you think of MMT, it has to be in a closed system. And right now, we're not in a closed system, which is why the commentary from Yellen about letting the markets decide the exchange rate is going to keep that system open. And again, these are going to be some of those things that we'll go deeper into as we go through the remainder of the year. But when we look at the FOMC, we have to look at, okay, well, dove hawk, not that we have many hawks at this point, given how easy Fed policy is, but you're looking at who are the 2021 voters, and you can see that they're starting to swing a little bit further to the hawkish side, but again, barely on that side. But Powell, Bauman, Brainard, Waller, those are, again, on the governor's side, you continue to see the governors heading towards that dovish side, and the voters, again, still maintaining that dovish stance, which we really don't see adjusting until, just given based on what the expectations are, 2022, and just based on some of the commentary, we've seen that President Biden will likely extend Powell if he wants it, because his term is up in 22, and that's going to, again, be an issue in terms of how dovish are we going to remain. Because where are our dynamics? Where are our metrics? And you can see the U.S. Treasury yield, interest rate continuing to make this new low. Savings as a share of GDP. This is one where as rising global savings pour into U.S. debt. So where is it coming from? So China, their percentage of savings as share of GDP has started to increase, but there's other issues within that, which we'll talk about in the last segment. Global has been fairly flat, but when we look at the domestic investment, average annual change in private U.S. investment has continued to fall in through the 2000s, 2010s, and that adjustment has to happen, because when we look at the GDP calculation, they really get a natural move. We need that we need that investment in CapEx. We need that investment on the private side. And we just haven't seen that because there hasn't been the incentive to do so with such low rates. It's like, well, if I'm a public company, I can borrow debt, buy back stock, and I have a net gain based on the financial adjustments, but I'm really not investing in anything. And by not investing in CapEx, you're not investing in people. And that's why when we talked about 2019 into 2020, we had such concerns. And then debt as a share of GDP continues to go higher. But again, there's a view that, well, GDP is going to grow, so we're fine. Okay, well, where's federal interest as a share of GDP? Because as rates fall, the share of interest for GDP, if you're going to inflate it away, you should see your interest as a share of GDP also fall. But as the Treasury interest rates get lower, we're borrowing more. So even though the rates are lower, we're still increasing principal. So we're maintaining essentially what our federal interest in GDP. So now, as we're borrowing more, we need to see that GDP grow faster. And we're not seeing the GDP grow faster because the consumer's struggling. We don't have as much private investment. We have the largest imbalance on our exports, imports ever, or at least going back to 2008. How much can the government make up? Should the government make up that much? And again, that's where we see this problem, because some have pointed to, well, in the 40s, we had the big spike in debt, and then as the economy recovered, things got better. Well, we were also going from a not world power or a budding world power to a world power. We had this massive expansion because everybody in the known developed world had their economies destroyed by carpet bombing. Are we going to see something similar where, not to say we're carpet bombing, but can we really get that same GDP bump that we had? Because if you think about percentages, we're a much bigger economy now. So to grow at such a level is going to be much harder versus something that was, again, a smaller number to a bigger, smaller number is a bigger percentage. So again, these are things to think about as we look at growth and debt, and how does that marry, and how does that cap, kind of where can we go from here? And just to rehash, just because it's so important, the net number of bets on the dollar in the futures market, you can see that just how elevated they are and how one-sided that trade is getting. And when we look at the share of allocated foreign exchange reserves, this is where we're back to 2010, 2014 lows. But when we look at the exchange, and this is where it's going to get interesting, because the euro has seen an increase of interest as the emerging market, companies, governments have wanted to take advantage of the fact that European investors are starved for yield. So instead of denominating it in dollars, they're denominating it in euro. But you can still see the U.S. still makes up about 61 to 61.5% of foreign exchange reserves. That Russia finally switched over where they have more gold than dollars. But that's not really going to get much different. And we actually expect this to start to increase as the dollar weakens, which is going, or remains softer, which is again going to support some of the interest in U.S. dollars. And again, when we look at month-on-month currency reserve changes, we're continuing to see those changes going higher as we go through 2020. China, Korea, Taiwan. It's not even just in U.S. It's just they're seeing an increase in reserves as exports remain elevated, imports weak, and that's increased the amount of dollars and or other currencies sitting on their balance sheets, helping to secure and protect some of their growth. But when we start to look at, well, where's the pressure mounting? And then we look at, okay, well, let's take a look at the U.S. consumer. Well, the U.S. consumer has seen a large amount of pain increasing on the delinquency side. So we saw some of those delinquencies go away as the money came in April, that was used to pay down some debt. So when we look at auto, we look at credit cards, we look at mortgage. So now as they've whittled through the initial $1,200, which is why that second round is important, you can see the delinquency rates have started to go back up from hitting that low in July and then going higher and higher. Now, it's not only just the one-time payment, but it's also the extended unemployment, which is when we look at credit cards, when we look at auto, and now when we look at mortgages, that's starting to creep a little bit higher. Now that if we get the extension, is that going to increase the mortgage problem as people say, okay, well, I made up some of the payments from March and April. I get this extension. I need the money elsewhere. I'm going to let that slide because there won't be much they can do to come at me in terms of some of these rates. And so the mortgage side, we expect to go higher as we continue to see some of the credit card, as we've talked about last week, with a lot of new debt was issued in order to buy holiday presents. But when we look, again, coming full circle to that mortgage side, apartment rent collections dipped in the fourth quarter. Now, this is something that is going to continue to increase in terms of that dip as we go through that extension into September on the moratorium on defaults, mortgage delinquencies, and forbearance. So these are things to look at. But while all of this is happening, well, you have the wealth gap growing. So the wealth gap, which we continue to look at, where top 20% of earners own nearly all the stocks held by the U.S. household, this 80% and above, who has benefited the most from this massive bull run in the market? And this is where it's weighted at that top. So again, this is that wealth gap continuing to expand. And just given the U.S. at new all-time highs, the NASDAQ at new all-time highs, this is only going to continue to move up and increase that pain, while the employment side continues to weaken. That low wage, that middle wage continues to underperform, where employment for low-wage workers still 21% from pre-pandemic levels. So not only are you trying to work more hours, you're getting paid less to do it, and your prices are going up. So you can't buy stocks, you can't buy hard assets, so you're stuck renting, so you're not gaining from this hard asset move. You're not gaining from, and again, this is that strife. This is what we continue to talk about with people feeling disenfranchised with the current environment. So then when we look and we turn to, okay, well, let's look at home prices. Home prices continuing to move higher, that 14 to 13.8%. We see this huge move off the lows coming back to some of the accelerating higher and this isn't going to stop. And this pain is going to continue to spread. And this is going to increase or essentially push people out of homes, because you still need a down payment. And if you can't get ahead on wages, you can't buy stocks, gain from that, sell your stocks to then put that towards homes. Yes, rates are low, but you don't have that down payment, which is, again, pushing people further away from the American dream or what other type of thing that we want to talk about. And then when we look at, again, the stock building on the U.S. side, the stock building continues to happen where wholesale inventories, retail inventories are starting to grind higher. They flattened out a little bit, but this is where we see that disconnect. And again, prices going up as the pain or the cost of moving this back into the supply chain is increasing that PMI, is putting more pressure on pricing, which again is going to lead to that additional inflation. And that's where we're a net importing country. So we're importing more, but when we look at the trade weighted US dollar index, it's getting weaker. So our price index is going up and again, this is that bifurcation that we're seeing in the trade market, which is going to be a much bigger issue as we progress into the market, as we look to how quickly are we going to be able to make this turn, because we're not seeing the dollar's not going as far as it used to. And when we look at, okay, well, if the dollar's not going as far as it used to, well, why not? And how are we going to adjust that? And where are we going to see some benefits? And when we look at, well, how are we going to earn money? How are we going to hire people back so that they can earn more dollars, so that they can cover some of this wage, get some wage inflation to offset some of the inflation out there? Again, number of defaults so far through 2019, 2020. You can see the acceleration from 19 into 20. 21, we're already seeing some of these, the pain in the number of defaults. Oil and gas, consumer products, media, entertainment, retail. We don't see that slowing. Obviously, a lot of the meat has come off the bone, but we still have a huge roll that's supposed to happen in March. That's going to be additional pressure on bonds in general. But, is there a better side to this? Is there a way where we're going to see new investment, try to incentivize some of this, these new private investment? And right now, America is seen as the most attractive business location among G7. So is this going to put more capacity into the U.S.? Is this going to help us in terms of, or can we see some benefits as we go through the next couple of years? Is a rise in tax rates. So when we look at some of the commentary from Biden, he's talked about raising corporate taxes. Based on this score, does that hurt the score? Is that going to limit the amount of people that are going to want to come here? When you look at the energy policy, is that going to increase energy costs, which is again going to dampen because in the investment here, because it's going to be more expensive to operate. These are things that we're going to have to weigh, but clearly the U.S. remains one of the favorites, which is, we need to nurture. We need to take this and really run with it, because this is going to be a bigger benefit, and try to cap this to attract new jobs, new industry into the U.S. to really kind of grow some of these job shortfalls that we continue to see as jobless claims increase. People sit in unemployment for over 29 weeks. You can't rely on the government to subsidize for so long. We're going to need that natural progression in the business cycle. And this is going to be a key component that has to be nurtured and really adopted to see this growth and this recovery in the global economy, specifically in the U.S. on a go-forward basis.